This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, I think there's just one game in town today, and that is the US inflation print. Is this going to be the report that Powell wants to see to turn firmly dovish? Certainly looking at the estimates, perhaps not. But maybe I shouldn't say that one game in town, because you've still got those expectations that are building around the BOJ.
There's one big central bank kind of game, right? And the BOJ is certainly part of it, albeit in a different direction. But yeah, we are seeing firming when it comes to the yen, firming of these expectations. It all comes down to wage growth. We're going to want to see a number, according to economists, of at least 3.8% in the wage growth numbers for that to not derail these expectations. But take a look at the open bell.
Yeah, and as you said, it's really this sort of shifting perceptions around what the BOJ is going to be doing in its two-day meeting. It actually concludes Tuesday of next week, so we really are on the countdown to that. But you are seeing that firming continuing in the Japanese currency there. Yesterday we saw the country avoiding technical recession in the fourth quarter. Today you've also had those producer price numbers coming out just in the last few minutes, and again, better than what economists have been expecting here. So yes, perhaps we could see a shift in March. Certainly it does seem from economists by April, but as you said, it does depend on the outlook or what comes out of those wage negotiations, and that's something that could actually be something to force the BOJ to end its negative interest rate policy this month if those numbers come in pretty strong. That's what local media is saying here. So we've got those negotiations. They actually wrap up Wednesday, get the first estimate out on Friday, ahead of the meeting that wraps on Tuesday of next week. So that's the sort of timeline we're tracking here. That's the outlook for Japan there. You've got stocks still under pressure. We did have a big drop in the yesterday's session. But Korea just coming online, looking a little bit better so far. It's pretty range-bound, but it is doing better than Wall Street here. We saw US stocks edging lower. It is that countdown, though, as you say, to the US inflation print. Still expected to be in that 3% territory. Core reading at 3.7%, according to our survey. So not quite down to the level, of course, that the Fed wants to see Haidi just yet.
We have had here in Australia a little bit of RBA speak as well this morning. Australian households clearly struggling at present with a number of headwinds. That was the messaging delivered by the Reserve Bank Assistant Governor Sarah Hunter. This is just a week, of course, before the RBA meeting next to decide on rates. So highlighting how difficult these rate hikes have been, with the inflation being the single biggest drag after those 13 hikes that we've seen since May 2022. But take a look at the broader markets. We actually are seeing kind of, modest gains here for the ASX 200, about 0.3% higher. This, though, coming after we saw really the biggest decline in a year for Australian equities. We were down 1.8% at the close yesterday. We are seeing a bit of a modest rebound. Banks, consumer stocks showing some of the leadership. Some declines for mining stocks, including BHP, Rio Tinto and Fortescue, extending that fall, but perhaps not as much as expected. Materials only down by about 0.1% at this point in the trading session. This after iron ore, of course, prices slumped the most since mid-2022, both on China demand, but also swelling inventory situation there as well. The Aussie dollar is holding up pretty well, all things considering, given that proxy that it has to how well or how badly iron ore does, and the lack of detail out of China's stimulus that continues to kind of more broadly plague sentiment. 66.16 is where we're tracking amidst what has been a little bit more of an elevation for the Bloomberg dollar index, seeing its first gain out of 7 sessions there ahead of that key US CPI print. And also finally watching the dynamic when it comes to crude supply, as well as really a pretty steady and kind of dynamic. The market is really in wait and see mode for the OPEC report, as well as inflation data there being due, as well as of course on the back of that 3-day drop that we've had in oil, pretty unchanged at the moment. Taking a quick look at treasuries, obviously, as Belle mentioned, that one data point in US inflation is really key. This really fresh data will be kind of what will drive bond markets from here in terms of when that first rate cut will come. And we've already seen this market react quite strongly to that somewhat mixed jobs report on Friday as well.
Yeah, let's get more on that now and bring in our next guest. Joining us from Singapore is Kelvin Tay. He's Regional CIO at UBS Global Wealth Management. And Kelvin, I guess the numbers later today in the US, it could just be something that really underscores to us that this Fed path toward cutting is still not certain just yet.
Absolutely. I think if you look at the data coming out last weekend with regards to the non-farm payroll and the unemployment market, the data seems to be a bit mixed, right? With your unemployment rate going up to about 3.9%. But the fact is that the US economy's jobs market still remains very, very robust, generating a lot more jobs than was actually expected over the last Friday itself. But if you look deeper into the details, some of the details are actually a little bit softer with regards to your wage growth coming in at 0.1%, and the fact that your December and your January jobs creation numbers were actually revised downwards quite significantly as well. So the path is not so smooth, but in the end, we still think that a June cut is pretty much in the books where the Federal Reserve is concerned.
And actually, Kelvin, on that point of those numbers that are coming in on the US economy, we've actually had Jamie Dimon saying that a US recession isn't off the table just yet. Is that something that you would agree or disagree with?
I think we think that the chances of a US recession this year is actually pretty slim, given the fact that, many quarters or many other aspects of the US economy remains very, very robust and very resilient. If you look at the GDP growth in the first quarter of this year, where things stand, we're still looking at about close to 2.3% on a trend basis. If you look at the growth last quarter, growth was actually pretty strong. And of course, the third quarter of last year surprised at about 4.9% as well. So we don't think a recession is actually in the cards here. Definitely not for the first half of this year, but perhaps in the second half of the year, we do think that the US economy would likely slow down quite a fair bit. But then again, the Federal Reserve trying to be preemptive here is largely because of the fact that, any slowdown where the US economy is concerned can be very deflationary in the early stages. And that basically means that the unemployment rate could perhaps actually surpass 4% on a short-term basis.
Kelvin, I want to talk about Japan because obviously there's that strong correlation with how US equities perform and how we see that pass through in Japan, but I've also seen a bit of a pullback on account of these BOJ expectations. Do you use these moments to add to positioning for Japan?
No. I think where the Japanese equities market is concerned, we're very wary of the fact that if the Japanese yen appreciates, the inverse correlation between Japanese yen appreciation and the Nikkei and the topics as well is actually quite strong. So any appreciation in the Japanese yen will likely lead to a negative performance on the Japanese stock market, and therefore we're actually quite wary of that. With the exception of perhaps the Japanese yen, Japanese banks, where, if there is any pullback, I think it's actually a good opportunity to accumulate, given the fact that we do expect the 10-year JGB yields to rise to above 1%, and that in turn basically means that the net interest margin expansion seen by the Japanese banks will likely continue. But on top of that, we do think that if the Shunto-Wich negotiations that you pointed out comes in above 4%, closer to the 4.5% range, then the chances of the BOJ reversing its negative interest rate policy will actually be pretty high.
Do you think then you're a little bit more, muted on expectations of some of the other fundamentals and thematics that have been driving the Japan equity rally so far?
Well, all that is true. Like, when people talk about the increase in the ROEs, the improved corporate governance, the disclosure, the increase in capital expenditure, all that is true, but you can't deny the fact that last year the main driver of Japanese equities was largely because of a weak yen. Japan was the only major G10 country to end 2023 with a real rate that was more negative at the end of the year than at the start of the year. And as a result of that in turn basically led to easing of monetary conditions, and in turn basically led to the equities market driving up those levels. So a stronger yen will certainly impact the export margins of the exporters, and that in turn will basically mean that I would say majority of the Nikkei or the topics will probably be negatively affected by that, where the earnings is concerned.
And when it comes to China, I feel like we've kind of wrapped up this year's MPC fairly neutral. I don't know if we got that much more out of policymakers that would drive the catalyst either up or down. Do you see still opportunities despite the sort of status quo of a structural slowdown for China?
Well, if you're targeting 5% growth for this year and your fiscal deficit as a percentage of GDP remains at about 3.5% to 3.8%, you are very unlikely to actually be able to achieve 5% growth. And that in turn basically means that China will probably have to step up fiscal stimulus in order to actually achieve that 5% growth target. So that's what we are actually watching closely. Now, on top of that, there have been some discussions on allowing the private developers to tap on at least 10% of the escrow funds in that sense. And that in turn could actually help them with the cash flow. But even then, we don't think that that is actually enough, because I think to reverse the negative sentiment in the property market right now, you really need the monthly sales or the weekly sales, at least, where the properties are concerned, to actually pick up quite substantially. Thus far, on a year-on-year basis, the sales of the private developers are down anywhere between minus 35 to minus 45%. And you need to have a reversal of sorts where that is concerned before positive sentiment can actually come back into the Chinese market on a sustained basis.
That was Kelvin Tay, Regional CAO at UBS Global Wealth Management. And let's take a look at some of the movers here, because we're just coming up to 10 minutes so far for trading for Japan and Korea this morning. And some of the ones that we're watching in particular are the steel shares, because we have been really tracking that move in iron ore over the past few sessions. That drop back below $110 a tonne that you can see there at the bottom of this screen. But you are just seeing that weakness coming through in some of those mining stocks. You've got Australian ones at the top here, but Japanese, Korean as well in turn. So it has been that broader weakness. It's really around the story of demand from China and that inventory build-up that we're seeing as well. And we just were speaking last hour about how no matter which time horizon you look on, shorter term, longer term, it's hard to be constructive on iron ore demand at this point in time. Let's change on and take a look at some other names that we're watching here this morning. Some of the names in the pharma space. We've seen Astellas Pharma. It's getting drug exclusivity for one of its treatments there. And we're also taking a look at Sosei as well. This company here in focus because it's going to be developing a schizophrenia treatment with a pharma peer here. But Sosei is going to be getting an upfront payment of 25 million euros for that. That stock there that you are seeing a drop for it in the session at this point in time. Quick change as well on what we're seeing for Oracle-linked stocks so far. We are seeing these again a little bit under pressure so far, even though Oracle itself has been rallying in late trade here. It did report a spike in bookings attributed to its cloud computing business. It is really trying to beef up that area to compete with the likes of Amazon, Microsoft, Alphabet, but those names are largely under pressure so far. It does sort of play into that broader trend, though, Haidi, it seems today, because a little bit of wait and see. It is that focus on the US inflation print, what that means for the Fed. Is it going to be a reading that surprises investors?
Well, coming up, Chinese lawmakers approve amendments to a law which tightens the ruling party's grip on the cabinet. We have the details next. This is Bloomberg. The Chinese legislature has voted to change a 4-decade-old law to tighten the Communist Party's grip on the cabinet. The changes would emphasize the party's leadership and encourage the cabinet to follow certain ideologies. Our Greater China senior executive editor John Liu joins us now from Beijing. So, John, is this another instance of how we're starting to really see the extended reach of the party across all levels of government?
I think this is the latest sign of that, but that is a process that's been happening ever since Xi Jinping took power back in 2012. The primacy of the party in all things, be it at the state-owned enterprise corporate level, all the way up now to what is essentially China's cabinet and decision-making at the highest level. That has been one of the core things that Xi Jinping has tried to change about China since he's taken power, and this is just another sign of him making additional progress on that front.
I guess this is something as well that extends beyond Xi Jinping, because you're also sort of looking at the governance dynamics into the future.
I think it's interesting the timing of this amendment change. This, of course, is the first year that the NPC is happening under the leadership of the new premier, Li Qiang. Li Qiang is, of course, one would say Xi Jinping's man, someone that Xi Jinping has a long work history with, someone that each of them, the two gentlemen, Xi and Li Qiang, have known each other for a long time. That, as opposed to earlier, the State Council, the NPC, being held under the auspices of Premier Li Keqiang, who came up through the system at the same time that Xi did, who was not part of Xi's camp, as it were. And so I think this also signifies that Xi Jinping's control over the government, over the party, over all the decision making in this country is stronger than ever.
As you talk about the primacy in just about every part of China, right, whether you talk about corporate boardrooms to, university lecture theatres, what are the implications for investors, right? Does that mean there are concerns when it comes to his ideology, his views on national security concerns, and how that impacts a lot of the companies that are being run within China?
I think the main concern at the moment is transparency, and that has to do with the elevation of national security vis-a-vis economic development in terms of priorities and importance. The concern is, to protect national security, does that necessarily mean there is going to be less information, less insight provided for the economy, for policymaking? And will that mean that investors in the business community are going to have to make decisions with less information available to them? That has made people more hesitant about putting money into China, and we've seen that in the FDI data. Obviously, the political situation with the U.S. has not helped at all. And so that is the main concern with the canceling of the Premier's press conference at the end of the NPC this year. I think that is continuing to underline that concern in the business community.
That was our Greater China Senior Executive Editor, John Liu, there in Beijing. And let's take a look at iron ore prices here this morning, because yesterday we did have that biggest drop since 2022. Today it's stabilizing somewhat, but still you're back below that $110 a level per tonne. You've also got Asian steel shares that are seeing weakness in turn from that. But let's discuss the outlook in greater detail, bring in our senior editor for China Energy and Commodities, Jason Rogers, who's based in Shanghai. And Jason, as we've been discussing, really shorter-term horizon, longer-term horizon, probably medium-term horizon, it's very difficult to build any sort of constructive case around iron ore right now.
Yeah, I think that's right. I mean, I think that the leg down that we've seen since the NPC is very much a comment coming from the market that it doesn't quite believe, or it lacks conviction in China's growth plans. Not necessarily the 5% target, but I think more about the fiscal measures to get there. And I think the market was hoping for more infrastructure spending, for example, at the NPC. That didn't come about. And what you're seeing now is iron ore dropping, and I think it's down about 25% from its recent highs. If you were to extend the time frame, you have to look at, everything revolves around China's housing market. And while you have this protracted crisis in the housing market, it's very difficult to make a case for any kind of gains in iron ore.
There's also the supply issue as well, right, with the new mine in Guinea. I do wonder, do you think that $100 could be in play soon?
Yeah, I mean, the Simandou mine is definitely going to bring a lot more supply online. I think you've also got a problem with China's steel market in that, less iron ore is being demanded, maybe more scrap steel is being used as a replacement. So there are supply pressures. I think the thing in front of us right at the moment, though, are probably demand pressures that could bring that $100 into play.
Our senior editor for China Energy and Commodities, Jason Rogers, there in Shanghai. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers can get that at Daybreak on your terminals. It's also right there on the mobile in the Bloomberg Anywhere app. You can customize those settings as well, so you just get the news on the industries and assets that you care about. This is Bloomberg.
A survey of Bank of Japan watchers found that a slim majority still expects the end of negative rates to come in April, even as March bets grow. For more, let's bring in our Asia economy and government senior editor, Brian Fowler, joining us this morning from Tokyo. And Brian, we've had some pretty strong economic data coming out. We've had this signaling as well from Bank of Japan officials. I guess it does really lend credence to every single meeting being live now.
Oh, it's extremely live. So, I mean, the breakdown right now is really almost 50-50. The number looking for April has come down to 54% from 58%. And those looking for a meeting, for a decision to move next week are now about 38%. And those numbers probably could increase. Of course, we are now at the peak of the annual wage negotiations. Those will culminate on Friday with the announcement from Rengo, but we're going to get drips and drabs. Every day we'll have a bunch of unions giving us some details tomorrow. We're also hearing from companies. Just last night, Kyoto reported that SoftBank has agreed to give salary increases of 5.5% on average to its staff, which is a new record. So we're seeing lots of anecdotal evidence pointing to really strong wage increases this year.
There's a lot more data that'll be available before the April meeting, right? So on the balance of things, what are the expectations in terms of a move this month, in terms of a move next month? And is there argument that, you know, if the market is prepped for it, maybe that is the window that they want to take, provided those wages numbers come in as expected or better?
Yeah, that's absolutely right. So it is true that in April there's going to be a lot more data to look at. There's going to be a meeting of regional managers from around the country who can update the policy board on conditions in local economies. There's also going to be the BOJ Tankan survey that comes out before that April meeting. However, as you say, I mean, the window is wide open, and if wage increases this year exceed those last year were the highest in decades, and it looks like they will be even bigger this year. And if that is the case, then I think the BOJ will have to say the window is wide open, seize the opportunity. I think there's a pretty good case to be made for them hiking rates on Tuesday.
There's a couple of cases to be made for how Japanese assets react, right? We spoke to Kelvin Tay earlier, who, you know, sounded quite cautious because of the very strong correlation between how markets have performed and the weakness of the yen. On the other hand, is there an expectation that maybe that reflationary confidence really gets a boost if the BOJ acknowledges that this is a sea change in how domestic assets should be valued?
Yeah, that's a key question, is how a rate hike would affect sentiment for everybody. And it's true for assets, it's also true for consumption. So in the GDP data we had yesterday, those revised stats, personal consumption was actually revised downward. And if you look at household spending, it's fallen year on year for 11 straight months. So one of the things we're looking to see is, will sentiment for everybody, including consumers, pick up enough that they feel like they can confidently go out and spend money again? And that would put the virtuous cycle of wage hikes, price gains into play, and that would give BOJ the confidence it needs to continue to hike at least once and maybe a second time further out.
Our Asia economy and government senior editor Brian Fowler with the latest on the Bank of Japan. Of course, the BOJ is one part of what we're watching, but also US inflation, how that plays through for the Fed. And that is how we're seeing global equity markets really pacing themselves at the moment. European equity futures coming online, looking mildly positive. DAX futures probably leading the pack there in Germany, 0.4% higher there. We have seen investors in this part of the world a bit more concerned about catching that next leg higher than really much hedges being put in place for a pullback. We've seen demand for puts over calls for European stocks falling. Markets have been rallying ahead of what we have seen as a bit of a pullback early this week as well. Watching currencies as well. In particular, we've seen really a bit of an outperformance in the latest rally for the pound against both the dollar and other G10 currencies, and that move in UK gilts as well in play this session, Belle.
Yeah, well, Haidi, markets might be pacing themselves, but cryptocurrency is certainly not. We're taking a look at how Bitcoin prices are faring today, and you're still trading above that 72,000 mark. We have never seen that before until the session yesterday, so we're up for 6 straight days. And year to date, we're looking at gains of around 70% at this point in time. As we've been discussing, it really is this big flow that we're seeing into these spot Bitcoin ETFs. That's creating a lot of demand for the tokens. That really can't be met at this point in time by the Bitcoin miners. And then you can add to that this anticipation of the Bitcoin halving event, which cuts issuance, and that's taking place in the 3rd week of April.
Some data crossing the Bloomberg when it comes to NAB business confidence numbers for the month of February here in Australia. We have seen really going into the end of last year, business confidence for the country plunging to an 11-year low, with consumer sentiment also in pessimistic territory. We are seeing the number for February, business confidence coming in at 0. We're seeing business conditions coming in at a 10. So this is really continuing to play into some of the concerns over sentiment, both for the corporate sector and households, as a result of 13 rate hikes from the RBA. And in fact, even to that point this morning, we did hear from Sarah Hunter from the RBA, the Deputy Governor, really acknowledging that, the Assistant Governor, I should say, really acknowledging that households in Australia and certainly businesses are clearly struggling at the moment. Belle.
Yeah, and Haidi, what else has really been struggling is the Chinese equity market to try and find a footing here, and rising geopolitical troubles, the latest issue that we're really discussing on that point. Let's discuss with Bloomberg's Asia stocks reporter Ishika Mukherjee joining us from Singapore. And Ishika, we always have geopolitics as sort of one of the themes that we're talking about. Sometimes the economy, other issues take center seat, but it does seem that geopolitics now coming back to the fore once again. How is that likely to play into the market dynamic over the nearer term?
Hi, Annabelle. Yep, here we are back talking about geopolitical tensions. I feel like it had died down, the discussions around geopolitical tensions, towards the end of last year. But just since the start of this year, we're seeing movement in terms of healthcare, technology, this chip space in particular. Also on the EV front, where the US is moving to curb China's sort of dominance or Chinese suppliers on the global stage. So, for example, in the healthcare space, of course, you have biotech firms such as WuXi AppTec and WuXi Biologics facing restrictions on accessing federal contracts. In the EV space, the US is talking about imposing certain restrictions that go beyond tariffs on Chinese smart cars and related components. And just this week, we broke news that Changshin Memory Technologies is facing potential sanctions in the US, being added to the entity list. All this, of course, is coming up ahead of the US elections in November, and we're just going to see this rhetoric climb as the elections draw closer. The MSCI China index has sort of slowed down, eased up on some of the gains, even though it's up 11% since a trough in January. But you can see how the NPC, together with these rising geopolitical tensions, is weighing on the market right now.
Ishika, as you alluded to, obviously more volatility ahead with the US presidential election. Do we get the sense that, the sort of short-lived stability could make way for more uncertainty?
Absolutely. Everyone sort of zeroes in on Trump when it comes to US-China relations. But as we've seen under Biden, this is really a bipartisan stand, right, that the US has taken against China. So in the past, actually under Trump, because of other reasons, of course, but the Chinese equity market actually rose 100%. Doubled. Whereas under Biden, because of China's own domestic issues, including the property crisis, it's done really badly. So some people, some market watchers are saying that, maybe Trump can limit the issue to US-China relations while Biden is trying to rally other firms, other countries rather, and make this a more global action against China. So things might even be better under Trump potentially for the Chinese stock market. It remains to be seen, but one thing we know for sure, that the uncertainty is just going to rise as the US election draws closer.
Our Asia Stocks reporter Ishika Mukherjee there with the latest. And let's bring in with some insights Elizabeth Economy, who's a senior fellow at Hoover Institution. Elizabeth, always great to chat with you. And to Ishika's point, what do you make of the risks in this bilateral relationship if there is a second presidency for President Trump, right? Do we get a slightly different set of dynamics given that Beijing is really perhaps more preoccupied with less bandwidth given the domestic challenges?
I mean, I think, listen, part of what we've seen just in the Biden administration has been a continuation of Trump administration policies like the tariffs. I think the issues that the United States now has with China around de-risking, both for national security grounds, but also for economic security, related to, for example, supply chains. These are not going to change from the Biden administration to a second Trump administration. And it's also important to understand that there's, concern within the U.S. business community about what's been taking place inside China in terms of all of their regulations around national security and the, constraints around the free flow of information that they need to make good business decisions. So there are many factors that are playing into what's going on inside the United States. So to some extent, yes, of course, the election will be one important factor. But I think the underlying factors in U.S. politics today with the Congress and with the U.S. business community are easily as important as any kind of transition we might see from a Biden to a second Trump term.
And if anything, which I think kind of goes to your point, perhaps the tenor has been more stable, but the policies have perhaps been getting more strict, right? We heard from Gina Raimondo saying they'll do whatever it takes to curb access to advanced tech. We know that there are trade barriers and tariff barriers going up everywhere related to EVs, to semiconductors. So does that make it even harder for China to be able to maintain its own domestic growth priorities? Around 5%. We don't know how they're going to get there. We certainly didn't really get a level of detail in this last MPC.
No, I mean, there are a lot of things wrapped up in that smart assessment that you just made. But I think, on the one hand, China is putting forth a fairly, confident projection of 5% growth. I think there's a lot of doubt in the United States that it actually achieved the, 5.2% that it said that it grew this past year. But beyond that, I think, for the United States, it's really important to understand that there are sort of distinct initiatives underway with regard to China. One is on when you're talking about chips, for example, these are related to the highest end chips. It's an issue of national security, right? Tied to, giving or not giving, but selling China chips that could be used for military applications that would undermine U.S. national security. Then there's de-risking, again, around supply chains, right? COVID was a wake-up call. We don't want to be dependent on China or any country or nation like Taiwan, for example, for chips, right? We want to have diversified and resilient supply chains. So you need redundancy, right? So that's a second de-risking effort. And then the third is around competitiveness. And I think here's where, this is the traditional element of the U.S.-China trade relationship, which is basically just China has a number of policies around subsidies, around non-tariff barriers to entry, around IP theft that the U.S. wants to address. And so I think there are sets of policies that are being put forward out of the United States. It's important to understand the buckets in which those policies, fall because they're different. And the last point I make on this is that this is not just a U.S.-China story. I mean, if you look at what's happening with Japan, if you look at what's happening with the EU and China, very similar, policies and trajectories of engagement in terms of the trade relationship, in terms of the investment relationship. So this isn't all just about the United States and China. I think this is really an advanced economy set of concerns when it comes to China.
Yeah, so to that point then, do we need to look beyond sort of the US-China bilateral relationship and also really seek to have greater understanding of the US relationship with some of those key allies?
Yeah, I think, as I've watched U.S. policy and then watched European policy and watched policy in Japan, there are moments in time when Japan has led. For example, on supply chain diversification, Japan was ahead of the United States. Certainly on chips and on chip manufacturing equipment, the U.S. has led. On the EVs, it was actually Macron that first came back after his big trip to China and said, oh my goodness, right, we're going to be swamped by Chinese EVs. What are we going to do about it? So again, I think in many respects, the overall policy toward China, the tougher line, I think, did initiate with the United States. But if you look at the China policies that have come out of Germany, for example, the China policy, their strategy looks just like the U.S. policy. That's not because the U.S. is telling Germany what to do. It's because over time, Germany has come to many of the same conclusions as the U.S.
But China does, of course, need to sort of export its overcapacity in certain areas. So if you do have that pushback from the US and from some of its allies, again, to Heidi's point, how does that play into the growth story there?
Well, it's challenging for China, right? But that's because they're not taking the proper set of domestic policies, right? They continue, right? If you look at what came out of the NPC, it was all about, investment in advanced manufacturing and industry. Right? Where were the policies designed to address consumption in China? They were basically non-existent. So I think that's they don't have enough demand domestically, right? So they are going to continue to try to export their overcapacity. Look, that was the origin of the Belt and Road. That was about exporting overcapacity in cement industries and construction industries, but that mostly went to emerging economies. So they're going to need to figure out their own domestic economy because I think they're going to find increasing barriers to many of their products, not just from the United States, but from Europe and other advanced economies.
Elizabeth, what is the biggest risk? I know you talk about relevance here and consequence. If the US and China continue on the path of de-risking on each side, and what does that mean, I guess, for this kind of ultimate threat of Chinese hegemony or China's concerns over US hegemony?
I mean, I like to think of it not as playing into sort of hegemonic aspirations, but instead that we're really trying to find a new equilibrium around de-risking. And I think, honestly, it's not easy. China, again, has always had a much more expansive concept of the relationship between national security and the economy. And it began, with indigenous innovation in the early 2000s. We've had dual circulation in 2015. We had Made in China 2025 in 2015, dual circulation in 2020. All of these were basically designed to protect the Chinese economy from the pressures of the global economy, while in fact trying to ensure that the global economy remained dependent on the Chinese economy. Now the United States is trying to de-risk itself. And so I think there's a little bit of catch-up going on here. But ultimately, we need to find a new balance. And I think that was part of the message that came out of the summit between President Xi and Biden back in November of last year, was that we're looking at guardrails, right? We don't want this relationship to devolve, certainly not into kinetic conflict, but we want to find channels of communication. We want to work these issues out. And, and the good news is there's actually a dialogue, a bilateral economic dialogue between Secretary Raimondo and Commerce Minister Wang Wentao. They are overseeing it, but the dialogue will be at the vice minister level. It's going to be happening next month in Washington. And so, hopefully there's going to be an opportunity to work through some of these big strategic issues at the same time as deal with some very specific company issues on the ground.
That was Elizabeth Economy there, Senior Fellow at Hoover Institution. And taking a quick look at Japanese assets, how we're faring so far in the session, given the lines that are actually just dropping right now from Japan's Finance Minister Suzuki, who's been speaking in Tokyo. We are just seeing a bit more strength still continuing into the Japanese yen, so you're below that 147 mark. Equities under pressure. They have really been a bit dented, not only by the moves on Wall Street, that pullback in tech, but also by that yen strength, something else playing into it. But Suzuki, as I said, speaking in Tokyo right now, saying that deflation, he can't say that's completely ended. He's saying that economic and price trends need to be checked comprehensively. Also that he can't tell what's missing in overcoming deflation as well. But he does expect that the BOJ will continue to conduct appropriate monetary policy, and that big countdown to the BOJ two-day meeting that wraps Tuesday next week. And we'll have more ahead. This is Bloomberg. The founder of Chinese boutique cinema chain Lumiere Pavilion says the country's cinema scene remains resilient. Jane Shao spoke exclusively with Bloomberg after the country saw record box office sales during the Lunar New Year period, despite slowing consumption concerns.
Since 1895, when Lumiere brothers first invented cinemas, it was the first time globally all cinemas are closed during those 3 years. It's really painful. I think it's devastating to this industry, and I'm very glad that eventually this industry is still very resilient, is coming back.
I know the average age of a theater goer is much lower here than in the West. 20 is the average age?
That's correct.
Are younger people coming back? That's the big key, because there's a lot of youth unemployment in China. There is, lack of discretionary money, right, at this time when the economy is so slow. So what are the trends that are going to make this a sustainable recovery?
I think cinema is still very affordable consumption, and also it's a social experiences. During pandemic, people realize how close you can be leaving this world for the paradise. At that moment, it probably doesn't matter that much how many material goods you have, how many houses you have, how many cars you have, but rather your experiences. We notice people are willing to spend more on immersive experiences, social experiences.
The ticket prices, you said it's relatively affordable, but
Yes.
have you had to adjust the prices because there is deflation, falling prices, and less spending power in the economy? So have you had to adjust the prices?
Well, I think there's some adjustment on the price, not only because of the deflation, but I would rather say depending on different types of the movies. In China, we have different prices for different movies. For IMAX 3D or special effects movies, we can usually charge more. But since pandemic, because the production cycle's been changed, we don't see that type of a products coming out.
Well, last year, there were no Hollywood films in the top 10 grossing films at the box office.
Unfortunately, yes.
Is that an ongoing trend, and why is that?
I think it's an ongoing trend, and also it's not only for China, but worldwide. Hollywood, these sci-fi action movies, big budget movies, did pretty well 10 years ago because there are not so many supplies then, and it is wall on the big screen, and people love to come to the theater to watch it. But now, given the technology is getting much more popular, in China you have One New Earth and Creation of Gods, also big budget action movies, sci-fi movies. Even in India and Thailand, they can produce their superhero movies, but instead, Hollywood, they need to have a bit more creativity instead of doing sequels for these superhero movies. I think this is probably some consumption behavior trends they have to spend more time on. Last year, Oppenheimer and Barbie still did pretty well in China. I think it's not like Chinese audience don't like Hollywood movies. We just like better storytelling movies. Doesn't matter who created it.
As a Lumiere Pavilion founder, Jane Shah, with Bloomberg's chief North Asia correspondent Stephen Engel. We do have some breaking news when it comes to the Argentinian Central Bank. The Central Bank of Argentina in what appears to be an off-cycle move, lowering the benchmark rate to 80% effective on March 12th. This as we are expecting inflation numbers to come through. They are expected to slow monthly, but still on an annual basis to top 280%. Remember, back in mid-December, we had the currency devaluation effects start to really abate, and President Javier Milei's fiscal efforts should also be bringing relative monthly inflation relief. We are seeing the Argentina Central Bank lowering its benchmark rate to 80%, out of cycle move there, and Bloomberg Economics had been expecting a hold as well in the next meeting. More ahead here on Daybreak Asia. This is Bloomberg.